Welcome to Alpha Recap, your quick, smart take on today's market moves from stockalpha.ai. Markets were closed for the day, and we recorded this after the close. As always, if you have questions, you can reach us at stockalpha.ai.
Hey everyone, great to be here. We've got a mix today. Legal relief for a big utility, an analyst reset in payments, and a standout set of industrial results from China. Lots to unpack.
Let's dive in. First up, the court ruling involving PacifiCorp, the utility owned by Berkshire Hathaway. A court sided with PacifiCorp in litigation tied to Oregon wildfire damages, narrowing the utility's exposure.
Right. That essentially removed a headline overhang for Berkshire's utility holdings. No dollar figures were disclosed, so we didn't see a balance sheet impact spelled out. But the legal uncertainty eased.
So, what really stands out here is that legal and regulatory outcomes are increasingly acting like discrete market catalysts. This wasn't a cash number. It was a risk removal event.
Totally. Analysts noted this as a removal of headline risk, rather than a straight earnings boost. Utilities often trade on perceived legal and regulatory risk as much as on yield, so that change in the narrative can shift how defensive allocations behave.
Short and practical version. If you're watching utilities, don't just track dividends and rates. Watch the legal calendar, appeals, and any insurer commentary that could follow. Appeals are the obvious next thing to watch.
Also, keep an eye on regulatory filings from PacifiCorp. Those documents often reveal more detail than a courtroom headline.
Okay, moving on to a very different corner of the market. RBC Capital trimmed its price target on global payments to $82. And the research note said that cut was driven by updated estimates.
That was a notable one. Payments got a little chilly today. Analyst target changes that are explicitly on estimates usually mean the model assumptions changed. Maybe revenue growth, margins, or currency effects.
So, yeah, the payment space got a pause. Cuts like that can ripple through the sector, especially for companies tied to merchant acquiring and processing volumes.
I mean, when you step back and look at this, it's exactly the kind of signal that can cause short-term volatility. Broker target moves often trigger index and sector flows, and algos notice that.
Quick explainer for listeners. An analyst lowering a price target doesn't change a company's operations overnight. It reflects updated expectations. Think of it as the model's author saying, we expect slightly slower growth or compressed margins.
Exactly. What matters next is the bank's full note, the company's guidance on its next call, and whether other analysts follow suit.
Short reactions.
Hold on, say that again?
Big move.
Yeah, that tracks.
Now, a different story from the industrial side, Sany Heavy Industry reported very strong 2025 results. Revenue was about $12.5 billion, net income rose to about $1.2 billion, up roughly 40%, and operating cash flow was about $2.8 billion.
Honestly, I was a bit surprised by this one. A 40% jump in net profit is huge for a capital-intensive machinery maker. It tells you there was real operational leverage and demand in construction and infrastructure.
Right, and the cash flow number matters a lot here. When a heavy equipment maker generates roughly $2.8 billion of operating cash flow, refinancing and leverage risk goes down, and management gets strategic optionality on CapEx or returns.
So in plain language, Sany shows pockets of industrial strength even as some service sectors, like payments, get repriced. That divergence is one of the main themes investors notice today.
Let's shift to retail attention and a fun data point. Google Trends showed a roughly 50% uptick in searches for Tesla, about 10,000 searches, and a 100% jump for the query Amazon USPS delivery deal, also around 10,000 searches.
Okay, retail, you're loud. Search spikes like that are an early read on retail interest and can presage volume or volatility, but they don't prove fundamentals changed.
Exactly. Momentum traders and algos often pick up on search volume. If the trend is followed by official news, like an Amazon Postal Service announcement or a Tesla production update, then the signal gets real weight. Absent that, it's noise with the potential for short-term swings.
Short reactions on search spikes.
Retail attention was loud today.
Watch the news flow. Fast.
Now on enterprise tech and security. Proficio picked up 5 global InfoSec awards at the RSA conference, and Factor 4 listed its gift card solution on Oracle Cloud Marketplace, which can help shorten sales cycles for software vendors.
Awards and marketplace listings are the classic playbook for enterprise vendors. Conference credibility plus easier discovery on a big cloud marketplace can accelerate recurring revenue if they convert pipeline into contracts.
Morgan Stanley also reiterated its view on Axon Enterprise, citing growth outlook. No price target was given in that note, so its immediate directional impact was muted, but it's still a signal of analyst confidence.
Right. The trend across these items is that platform and channel moves matter. Whether it's an Oracle listing or a conference award, these can become durable revenue levers if follow-through occurs.
We also had some smaller but notable items in wealth management and franchising. Sanctuary Wealth added a firm to its platform, a sign of advisor recruitment momentum. EmpiroClean was active at industry events to build franchise and insurance relationships.
Advisor breakaways and platform consolidation are slow burn stories. Growth shows up later in assets under management data and advisor headcount, not overnight.
Quick hits recap: Proficio's awards, Factor 4 on Oracle Marketplace, and Morgan Stanley's reiteration on Axon. Rapid updates, but individually, they're more about pipeline and distribution than immediate earnings shocks.
Those are the sorts of items that matter in the quarters ahead if they convert into customers and recurring revenue.
Let's pull together the emerging patterns we saw today. 1. Legal and regulatory outcomes, like the Pacific Core ruling, are acting as discrete catalysts. 2. Attention-driven volatility from search spikes can create short-term moves. 3. We saw earnings divergence, strong industrial cash flow at SANY versus estimate downgrades in payments. 4. Marketplace listings, conference awards, and partner ecosystems remain tactical go-to-market levers. And 5. Advisor and franchise consolidation continues quietly in the background.
I'd add one practical note. When you see analyst changes labeled on estimates, dig into what was revised: revenue, margin, or currency, because that tells you whether it's a demand story, a cost story, or a math update.
Good point. And for folks tracking utilities, the Pacific Core ruling is a reminder to watch legal calendars closely. Appeals, settlement notices, and insurer commentary are the next thing that could move the tape.
So what should listeners have on their watch list for tomorrow? First, any appeal filings or regulatory commentary tied to Pacific Core. Second, RBC's full note on global payments and any follow-on analyst actions. Third, official confirmation or denial from Amazon or the Postal Service on the shipping story, plus any Tesla filings or production notes explaining that search spike. And finally, RSA follow-ups and any Oracle partner disclosures.
Bottom line, today's tape offered a mix of legal relief, analyst recalibration, and clear sector divergence. The Pacific Core decision removed a headline risk for Berkshire Hathaway's utility operations, while the RBC cut on global payments highlighted renewed scrutiny on payment growth assumptions. SANY's strong results showed pockets of industrial strength, and search volume spikes for Tesla and Amazon signaled possible short-term volatility.
Remember, analysts note trends and data, and this recap is informational only. We're not providing personalized investment advice or suggesting anyone buy, sell, or hold any security.
Takeaways. 1. Legal rulings can meaningfully change perceived downside for utilities. 2. Analyst estimate-driven cuts deserve a closer look at model inputs. 3. Earnings divergence means sector-level stories are still driving performance. 4. Retail attention metrics are useful for spotting short-term noise versus long-term signal.
Thanks for listening. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
See you tomorrow. Keep your news feeds handy and your models updated.